This video will be concerned with working capital. Working capital is equal to current assets less current liabilities. Working capital is essential for the smooth operation of most businesses, especially manufacturing. And we'll talk about manufacturing later on in a diagram that we're going to meet. It enables continuous production processes with the output flowing into stock and ordering being met out of stocks. So working capital looks at items such as inventories, cash in the bank, and makes sure that the business can meet its obligations. But it also tries to have a continuous production process. So if it's manufacturing, even though the orders may vary, orders may come in some days and not other days, they try to keep the production smooth because that's efficient. This means that some production will go into stock, and then when orders are received they will be met out of stocks. Now, managing that process is important. It's important to ensure that the customer is satisfied with the service, but also that the stocks are not too large, because holding stock is expensive. So the management of working capital is critically important for the survival of the business. So if we have continuous production, the continuous production flow into stocks and out of stocks to meet regular customers, but also periodic orders. Now, that process needs to be managed. They don't want to keep the customer waiting too long. On the other hand, you don't want to have too many stocks, because stock is expensive to hold, generally speaking. So let's look at the flow of capital within a business. I'll start with cash. Well, with cash we have the outgoings. Outgoings for raw materials, labour, machinery, research and development, administrative costs, marketing, HRM, accounts, and so on. So we have many outgoings from cash. All of these need to be paid for. Now you'll see from the diagram, as I said right at the start of the video, we're taking a sort of a manufacturing approach here. But the same applies to any business. Just with manufacturing it's a bit more complex. There are more issues to take into account: machinery, plant, stock, etc. So we'll just look at this one as an example. But it applies to service businesses as well. So we've got cash and the outgoings. Now, we've also got creditors. Now, creditors enable the business to perhaps receive raw materials and pay for the raw materials later. But again, the creditors must be managed. When the bill is due, when the invoice is due for payment, the cash must be available in the bank. It must be managed to ensure that amongst all of the outgoings for all the various requirements as listed here, raw materials, labour, research and development and so on, all of those have to be paid for. But the creditors must be paid for as well, and it all must be managed, it must be overseen to ensure that that happens. If it doesn't happen, the business is in trouble. The business could fold. And the effect of, or the usage of raw materials, labour, machinery and so on, is to generate work in progress. These are items which are perhaps semi-finished. The raw material has been transformed into something near enough, almost the final product. The components have been produced, the assembly might be done. Depends on what the functions are, what the requirements are to make the particular product. But putting all of these together, the machines, the labour, the raw materials, putting everything together, the upshot should be work in progress. And from work in progress, we would get the finished goods. And the finished goods, the function of the finished goods is to be sold, and it may be sold to debtors. So they may be sold on credit, for example. So in other words, people receive the finished goods and promise to pay for them in a month's time. Now that needs to be managed as well. So there is more to the management of working capital than meets the eye. Every bit of it needs management. The debtors, when they do pay, that cash flows back into the bank as a form of receipts. So you can see this diagram has become a little bit more sophisticated. Now we can continue to make it more complex, and we'd have to obviously relate the diagram to a specific business, but the essence of the management of capital, working capital, is in the diagram in front of us. Now, the flow of working capital within a business, well, it's obvious that the inflow of cash should exceed the outflow. If it's not the case, then the business is in real trouble. The business will cease to exist. So if it were not the case, the business could not continue. It needs a surplus to pay dividends, pay its tax liabilities and other business expenses. Now, whilst regular customers may be predictable, the business may also receive exceptional orders from time to time. And in order to facilitate these extra and exceptional orders, the business will attempt to meet them out of accumulated stocks. And of course, failure to meet these orders within a reasonable time period may result in the loss of the order. So sometimes businesses face orders which are erratic. There may be 2 or 3 within a month, and there may be 6 months without any. They don't know when the orders are going to come in. But when the orders do arrive, the companies or the people placing the orders want to receive the goods perhaps as fast as possible. They don't want to wait. So the onus is on the business to produce items and keep them in stock. But how many should they keep in stock? That's the problem, and that's where the management of working capital is so important. Management accountants will give estimates of how many, but really it bubbles down to sophisticated guesswork. Careful monitoring of cash flow of a business is necessary to ensure sufficient cash to enable the business to continue to function. In the extreme, if the cash flow situation is bad, vital payments such as wages and salaries cannot be made, and ultimately the business will close. The management of working capital revolves around the careful monitoring of creditors, the stocks and the debtors to ensure that the business can meet its obligations, can pay its way, pay its bills, pay its workers, pay for the raw materials, pay for all the functions that we saw in the diagram earlier. If it can't pay for those, then the business will cease to exist. We've talked about the importance of finished goods in this session quite a lot. In fact, working capital is everything that facilitates the smooth operation of the business. And by everything is meant non-human and capable of transformation into final output. So it's raw materials, semi-finished goods, but also it's ensuring that the workers get paid and that there's sufficient cash in the bank to enable the business to pay exceptional items, to meet any unforeseeable demands on its resources. The management of working capital is vital for the continuation of the business. Sorry, I flashed the wrong slide. Working capital is composed of short-term loans and overdrafts, stocks of raw materials, work in progress, stocks of finished goods, cash and debtors. And these need to be managed effectively so that obligations can be paid and met, and all at the same time there's not too much cash in the bank, because excess cash is not working. So they just need enough to meet the obligations. It's all a balancing act. But get it wrong and the business will be in trouble. Okay, that's another view of working capital. There are other videos on this topic available. But we'll leave this one for the moment and leave it at that, and thank you for watching.